Markets are once again in positive territory as many North American investors take cheer from the most recent producer price index numbers in the United States earlier this week, which could suggest that inflation is on a cooling or declining track. Our next guest is Art Hogan. He's with B. Riley Investments. He's the chief market strategist there at B. Riley Wealth Management, I should say. Art, welcome to the program. Viewers who have good memories will recall that you have had a target of 4,500 on the S&P 500 for the end of this year. You're sticking with that target. That represents about 7% upside from current levels. Do you think that the producer price index numbers from earlier this week add to that thesis?
I really do, and I would tell you that it feels like we're transitioning from a July that was really driven by better than feared earnings results for the second quarter to August, where we're really seeing sequential improvement in economic data and some of the inflation inputs, whether it was on the ISM prices paid, both services and manufacturing, or the CPI that we got on Wednesday or yesterday's PPI, show some improvement. Now, we're still in a tough place in terms of inflation, but for it to be improving as much as we've seen in recent times and believing that this is the beginning of a trend, I think it takes some of the wind out of the sails that the bears have that it's going to get worse, and certainly the Fed needs to get much more hawkish. So I think that if you were to look at the commodity complex, for example, across the board, trading much lower than it did at its peak, and certainly when we look at energy prices, for example, gasoline prices having been down for about 50 days in a row, things are working in the right direction. A lot of that has to do with normalization of consumption patterns. We're consuming fewer goods and more services. I think that's normal. I think that as we work our way through the third quarter and into the fourth quarter, those trends will continue, and I think it's just going to make it easier for corporate America to post better than expected earnings in the third and fourth quarter, and certainly for margins to improve. So I think things are getting better. They're still not great, but they've certainly gone from horrible to just bad.
You and I several weeks ago talked about the Bank of America Fund Manager Survey, which showed sentiment among fund managers, professional investors, to be really at record lows. That survey got a lot of attention at the time. Another thing you're looking at in your most recent note is positioning, and you note that many institutional investors cut their equity exposure to the lowest levels since the financial crisis after the first half of this year, which is a pretty difficult first half. Why do you think that is potentially a setup for a rally?
Well, I would tell you, in the industry of being a professional investment advisor, when markets go down, it's okay if your performance isn't great, but if markets are moving higher, you definitely need to participate in that. So it's the old saying goes, we all go down together, but don't go up without me. And I certainly feel like that's the tone as we enter the second half here. And with positioning ultralight, you certainly have portfolio managers that are going to need to chase this rally, that are going to be caught behind. It takes a strong constitution to be underinvested in this market, as we are 20% off our lows in the NASDAQ and about 17% off our lows in the S&P. So I think that is one of the catalysts that drives. And just to get back to sort of a normal place and positioning likely continues to move us higher. I think on a technical basis, if you were to look at the midpoint between the S&P 500's peak and trough of this cycle, and that gets to about 52.31 for a 50% retracement. I think that's going to be a key technical signal if we close above that. We touched it yesterday. We're touching it again today. We close above that. I think that sends a signal that historically is the difference between rally in a bear market and the beginning of something larger. It's very infrequently, if ever, that we've seen a 50% retracement of the drawdowns that we see and then return to make new lows. So I think that's another positive signal that we're looking at this week.
Okay, with all of that in the background, what type of portfolio composition do you recommend to clients these days?
Well, we're really recommending and sticking with a barbell approach. So on one side of that barbell, we want to invest in growth, but that growth needs to be measured in a price to earnings. There's certainly been a significant bounce from their lows in some of the mega cap technology companies that have price to earnings, but the price to earnings ratios still look very attractive. On the other side of that, you want to be a bit more defensive and cyclical. And by that, I mean things like energy, best performing sector in the S&P 500 this year, likely will be next year. I think that continues to show very strong dynamics. And with the recent pullback in the commodity price, valuations look very attractive there. We like financials. financials have not performed very well this year. And we continue to believe that increasing economic growth in the second half, GDP growth likely picks up. Demand for both commercial and consumer debt will continue to increase, and the net interest margins continue to increase there. In the third place, we'd look on the other side of your barbell is industrials. Industrials really a cyclical play, but just remember we've got a lot of infrastructure spending in front of us. Industrial multiples are trading at all-time lows or near all-time lows. We think that's a very attractive space. The important thing is not just to set it and forget it. You want to make sure you're balanced, whether you rebalance every couple of months or every couple of quarters. You want to make sure that asset allocation is level so that that barbell approach continues to work. We applied that approach in the first half of this year and it outperformed the S&P 500. We likely think that's the best way to navigate these turbulent waters over the course of the next 12 to 18 months.
I heard you say that you think you forecast that the energy sector will be the top performing sector next year as well. So you see about 18 months of outperformance from energy stocks.
We really do. I think the supply and demand dynamics are going to be hard to catch up to, right? And by that, I mean, we just can't get new supply fast enough. While rig counts have gone up for 53 weeks in a row, it's just going to take a lot more production to get back to a place where supply and demand are in balance. So, whether we sort of stick, around 95 to 125 on WTI, which seems like a healthy place to predict that will be for the rest of this year, that is a price at which energy producers, North American E&P companies, and the multinational oil companies still make a lot of money. So I continue to believe that over the course of the next 12 to 18 months, energy will likely be the best performing sector in the S&P 500 by a long shot. And I continue to believe this is a very long-term trend.
Art Hogan.